long do you think this rally is going to last in equities? Like this seems like it's like peak stage three now with rate cuts. Rate cuts were priced in, and now they're actually starting to be priced out. Yet we're in a situation now where it's like every possible scenario is bullish for equities. Like more rate cuts, bullish. Less rate cuts, bullish. It's just
Right.
we're kind of in that environment where like there's no bad news anymore.
Yeah. So obviously the market's up, right? We're hitting new all-time highs. And I think that the biggest pending factor is that stage four slash recession, right? If you don't have that recession, what's going to happen is you're almost giving the green light without a recession that growth will continue higher or continue on its trajectory of, positive plus anywhere over a 1.5% GDP every quarter. And so far, that's what we've been seeing. So I think that as long as that's happening, you're going to get that above trend growth effect, and the market should bid up on that. The one driving factor, again, or defining factor, would be that recession stage four. And stage three is really what this is, right? This is stage three. The idea that after the immense amount of policy action via the Fed, there's this delayed effect that is going to seep through the system and will be variable. And the effects will be long and variable. No one really knows how much and when they all come to fruition within the economy. And in that process, everyone starts to get the green light that it's all okay. And that's what stage three of this four stage compound landing is, right? Everything normalizes. Inflation kind of holds a bid, which we're seeing, and it can go up, but that's more of the beginning phases of stage three where inflation rebounds and people are like, wow, okay, maybe we have a problem on our hands. Did the Fed do enough? And some of those inflationary effects are because of that normalization process. But we've um, moved past that to the point where inflation is stabilizing, pinning, as you could say, sideways, and growth remains resilient.
Yeah, so
And
what is going to take us to stage 4 then? If growth is still resilient, inflation is under control, are we ever going to see stage 4?
well, just remember, inflation is controlled, but it's not. And let's put it this way: inflation's contained, but it's not under control, right? We're not under 2%. So just remember that the Fed's expecting, or the Fed's illustrated that they're looking at three rate cuts this year, right? The market went to price in six. The reason the Fed is looking at three rate cuts is they don't want to over accommodate an above trending economy, right? So what they're basically saying is they want to remain restrictive along the way. And therefore, they want to keep the brakes on the economy along the way. So expect that at some point stage three is going to burn out because we're in a positive real yield environment. The Fed is the Fed's funds rate is over the rate of inflation, right? And forward inflation expectations are below short-term yields. So we're positive real yields across the board, and that will make that will be a sustained that will basically run through as a sustained environment until the Fed decides to materially bring down interest rates, and that's not going to happen until we have inflation under 2% or trending at 2%. 2.1%.
Or
You
until
get what I'm saying, right?
growth is destroyed as well, right?
Well, that's another factor. If growth gets so remember, if growth gets destroyed, right, in this time period between when the Fed can get inflation under control, um, and that growth being, or I should say, if growth gets destroyed before inflation gets down to target, inflation will then be at target, below target, right? Because if growth gets destroyed, the economy is slowing, inflation is going to slow down.
Yeah.
That's what the Fed is battling right now. They want to dampen the economy, right? And in the process, they want to keep growth contained so they can control inflation. The idea here is that inflation is trending sideways. The Fed's positive real yields. They have a grip on the market. Growth is going to burn itself out. That's what they're expecting. It's kind of like you have a candle, right? And you put a cover over the candle. The candle will burn for a little bit before the flame goes out. as it uses up the oxygen. And that's
Yeah.
pretty much what we're seeing
Like we,
going
we
on
need to
here.
start seeing growth roll over, which we're not seeing at all right now.
Right. And that's something that is going to be a primary driver of rate cuts. Growth rolling over
Yeah.
and or inflation under trend. If those things aren't happening, there's no incentive for the Fed to rush to bring rates down. There's no crisis, right? It's not like the S&P is negative 35% off the highs and people are scared, right? Panic is ensuing in the financial system. There aren't these issues right now. So the Fed can play the long game. And the risk that's going to happen, or the risk that's on the table here because of that, is staying too high for too long. And this is the whole process of stage four. And we said this about a month ago or a month and a half ago, that the Fed should really start gradually bringing interest rates down, even if it's one cut at every other meeting. And in the last FOMC meeting, they finally came out and made that clear. It's something that we said prior to that meeting that we think the Fed should do. And they actually did do it. And they said that they're starting to think about rate cuts, right? They're not doing anything obviously yet. They want to see the data develop in their favor. But the whole point is they need to start moving rates down, because even they know that the longer they stay up here, the longer the risk, or the larger the risk grows, that they are going to overstay their welcome and be in an overly restrictive environment for way too long, because they're obviously overly restrictive, right? They
How,
are they
how are
are
they overly restrictive right now if growth is able to remain resilient? Doesn't that mean they're not restrictive enough?
No, not necessarily, because when you look at this from the whole picture, growth is resilient, right, on a GDP perspective. But when you look at corporate earnings growth, and stuff like that, what's moving higher right now? It's not the small caps, right? So you don't have this equivocal effect of growth across the board.
It's
And the
like
reason for
targeted growth in
it's
certain
like targeted
sectors.
growth. It's yes, and like remember, there's companies that need to borrow, and they suffer at the expenses of these higher interest rates. And there's companies that don't need to borrow, and they're more bulletproof per se. Notice how like the Russell is, if we take a little measuring tool here and we go from their all-time highs, we're talking over 20% off their highs. Meanwhile, the Nasdaq and S&P are printing new highs. Now, there's a lot of junk in the Russell, right? But this again is another indicator that the overall economic situation, it's when if you were to just look at the Atlanta Fed GDP nowcasting model, excuse me, you would think, oh, we're in a great economy, everything's booming. Well, it's not really so, right? It's 2.4 or 2.5 ish% um, quarter over quarter real GDP, which is good, but you have a lot of constraints on liquidity that the Fed needs to have in place. Now, say the Fed were to reduce those constraints of liquidity, I think you would get a hotter growth number. There'd be more money flowing back into the system, and in turn, you would get that issue of inflation actually coming back up again, which is why the Fed's in this position where they have to hold interest rates and they have to be overly restrictive, which they are. And when I talk about being overly restrictive, I'm not saying something like you can't look at the Fed from a growth perspective and say, oh, growth is positive. They are not restrictive enough. Because the thing about growth is you can have an economy that's slowing, theoretically, with positive quote unquote real GDP growth. As long as that positive growth is declining in nature, right? So if we were to look at, see if we can get a little bit of a GDP now, we can pull this up on here, right? Coming out of COVID, we hit 37% quarter over quarter real GDP growth. Ridiculous, right? And since then, we've been coming down slowly and steadily, right? And the idea is that this can trend lower here towards zero, float around zero, and be slower. They dampened the economy. They brought it down from an over 5% environment with obviously raging inflation to match this. They haven't destroyed growth in the process, but growth remained positive and it slowed because they were restricted, but they didn't have to crush the market or the economy. And that's what we saw here. If we were to take a quick zero line, right, and you were to see something, we had that. Let's see.
It sounds like what you're describing is a soft landing.
Theoretically, yes, but this is where it gets very interesting, right? So we have, let's just mark this at zero, right? And as you can see here, that in 2022, the market priced in something that was way worse than this little negative lip here, right? That's why the market shit the bed extremely hard. And the idea here is that the Fed, this is what the market is actively pricing in right now, which is what you can see across. We're going to do a high level overview across the big stock, large cap stocks, the small caps, and bonds, so on and so forth. Growth is still resiliently strong. It's dampened though. We're seeing this come back down. Obviously, the Fed is going to want to see this trend down a bit more. They want closer to zero to confirm that they can start taking their foot off the gas, off the brakes, I should say, right? And inflation at that time should be below target, at or below target. That's the goal. The problem is quarterly GDP obviously is a lag. There's a lagging factor. Inflation itself in measurements has a lot of lagging factors. Their fundamental basis for monetary policy is behind lag. So the problem here is going to be, do they stay too high for too long and put too much of a grip on the economy because they're looking to achieve this soft landing? The idea that they're going to time the interest rate cuts to be aligned with moderating growth, a slightly weakening labor market, and falling inflation. The problem is how do you time all those three together? And that's what stage 4 is. In trying to time the growth and inflation part of this equation, or the growth or the inflation labor part of the equation, you're going to end up blowing one out in the process, right? And you're not going to be able to time all three of them correctly because they all have their own independent and variable lags. So the idea, what the Fed is trying to portray with the soft landing, is that they can hold rates in a restrictive state, gradually reduce them, and over time, inflation will settle out and we'll get in a recession, or something like this, little negative blip in back. But the problem is when growth is fading towards zero, right? Remember what the market was doing as soon as growth started fading towards zero here and breaching zero in 2022. The market is down 30%.
Yeah, the market was pricing in worst case scenario.
Right, because the market knows that once you start getting into that environment and growth starts falling apart, inflation starts falling down. You get this it's not very long, but you get a deflationary cycle where growth is down, inflation's down, and therefore you have this little bit of a cycle where the Fed has to come in. They don't have to, but they do, and they try and stimulate the economy with inflation, right? Giving a artificial demand and putting a floor in, and in the process, the economy rebounds. Now, I think that the idea of a soft landing it makes sense. You look at the economy right now, 2.3%, 2.4% GDP. Stock markets, major indices, all-time highs. Employment near lows, right? Looking great, looking like a soft landing is going to happen. And this is also confidence inducing to the Fed, because they look at this and they say, okay, we can hold for a bit, higher for longer, right?
Well, so what
Higher
are
for
bonds
longer.
telling us? The 2s and 10s are reverting, heading back towards zero. What is that telling us?
Well,
Typically,
with that,
before almost every recession, the 2s and 10s revert back above zero. So the yield curve normalizes and then a recession hits. So we're seeing this yield curve starting to normalize. What is that telling us? Is that telling us that, okay, there's no recession happening, it's time to go back to normal? Or is it going to be leading a recession like usual?
well, that's the soft landing, right? Remember, this is stage 3, I should say. Stage 3 is the normalization and the pricing in of the soft landing, right? Normalizing the economy at a higher interest rate. And if you can normalize the yield curve at a higher interest rate, what should happen to the yield curve?
Like the
It
entire curve will rise.
theoretically, right? Well, it should stabilize. You shouldn't have this huge inversion, especially on the long end. And that's what we're seeing, the stabilization of the yield curve. And once this breaches zero and starts going up, I think that's a decent indicator that we've really priced in the idea of a soft landing. Like really in full across all aspects where you're in a soft landing. Like the market's baked it completely and it's kind of writing it off, and it's gonna move its objective to something else, the next issue at hand. Right now, soft landing is still the issue at hand. And I think that in the process, remember the Fed is also going to theoretically, a lot of this move is that it is part of the soft landing. As the Fed reduces the front end of the yield curve, they price in rate cuts. The front end's going to fall faster than the long end. It's going to normalize the yield curve. And the reason they would cut rates is they're overly restrictive. They want to accommodate, keep the real level of interest rate. And remember, when I spoke to you earlier about growth, the Fed is more focused on real policy rates, obviously employment and inflation, right? So if real policy rates are widening because inflation's falling and their policy is stuck at a high level, they're actually growing in restrictiveness, and that growth and that expansion in restrictiveness takes time to shock into the economy. So when you look at the economy at 2.4% GDP growth, if the Fed were to hold here for another 12 months, will it still be 2.4% GDP growth if inflation continues to trend slowly but surely lower? The answer is most likely not, because that level of restrictiveness will widen, where if inflation is starting to drop, right, and it gets to the 2% target, and the Fed is stuck at 5, you have over a 3% real yield spread. You're going to attract dollars out of the system, right? You're going to pull dollars out of the system, even destroy liquidity even more and more. And this is a compounding effect. It's going to slow lending, slow the movement of capital, and therefore slow growth over time. That's why the Fed is very cautious and they want to bring rates down, which we said they should, right? Because and that's going to semi-price in a stage 3. It's going to almost like trick the market into thinking, oh, stage 3 is coming, right? But if you
Yeah,
really want to
that's
soft
so
land,
true. Like as soon as they start cutting rates, everyone's gonna get extra bullish.
right? And like they need to cut rates though. This is the dilemma Powell's in right now. Powell knows he has to bring interest rates down, even if it's one cut at every other meeting, one cut at every 2 meetings. He knows he has to start doing something soon here. The problem is he knows that once he makes the first move, it's like you get to make one move, and there's 6 moves on the chessboard made on the other side. 7 moves on that. So he knows that everything he does is going to have a compounding effect. So his dilemma here is, if he starts cutting rates, how aggressive is the market going to get in forward rate expectation reductions? And therefore, remember, if the market's pricing in these rate cuts across the Fed fund futures, the market's seeing it. That means the yield curve's also pricing that in. That means like things like mortgages will start getting cheaper. Things will start getting cheaper automatically, right? Like if we look at
And
just the
that could
30-year,
spark another inflationary issue.
right? Like the Fed hasn't moved interest rates since October 2023, right? But rate cuts have immensely picked up, right? So mortgage rates are lower, right? And just because of that, financial conditions have somewhat eased. So he has to be very careful with how he moves forward. And like we were saying, it should have been, or they tried to make it be a very clear path that, they wouldn't, unless something drastic happened, they wouldn't even look at more than 3 rate cuts in a year. Something existential would have to happen for them to go beyond that and really solidify the fact that they're here to tighten real yields, keep them tight, not too restrictive, and basically follow inflation down. Because once growth becomes, or once inflation becomes no longer is an issue, excuse me, then growth becomes the controlling factor of where the economy goes. And the problem here is that if the Fed doesn't cut because they're afraid of inflation coming back or growth is still too hot, which those were the 2 factors I elaborated on earlier. You can't strike all 3. What's going to happen is the Fed's going to overstay their welcome. And these widened or wider state of real positive policy environment, this wider range of positive real policy that we're in right now is going to have forward effects that have yet to be seen, right? Every day you can almost think about it like what's done today, the environment of the Fed today won't be undone for quite some time. So if the Fed changes policy tomorrow, one rate cut is already priced. If they cut rates one time, right, we're already pricing in 6 over the next 12 months.
Yeah.
So the Fed is already in this position where they are running the risk of being too strong, too high, or too tight for too long, and therefore it has a compounding effect on growth down the road that we can't measure today. But what the market's looking at face value is bonds, right? We'll take the bonds for example. Bonds are off their lows because we priced in those rate cuts, right? And the prospect of the Fed staying higher for longer is brought them off their, like, this was a rapid price in cuts. Cuts are being removed, bonds are bouncing back, rates are bouncing back up, and bonds are bouncing down. Now, why are they doing that? Well, if we're in a higher for longer environment, it's simple. Unless the Fed reduces the floor of that higher for longer environment, that average, bond prices aren't going to go up the same way equity prices are, because equity prices have a stronger resiliency because they're not tied directly, literally, to monetary policy. Bonds have a growth factor for sure. If growth slows down, bonds will start accelerating because there's an anticipation of rate cuts that are going to come. But if the market's well guided on those rate cuts, and it thinks the floor is going to be a higher for longer floor, bond prices aren't going to rip roar and skyrocket as they would do in stage 4. And that's the driver for stage 4. This idea that we have a higher for longer environment that is too high and or too long. And what you end up coming out of with this whole thing is a somewhat smacked around economy that is going to fade basically and suffer the consequences of too stiff of a policy for too long. And that's what stage 4 is. Stage 4 gets invalidated if the Fed really does pull off the soft landing. Then you can, like, theoretically, but now you might think, oh, if we pull up a soft landing, how do you know? Because you just said if the soft landing's priced in at a maximum, then it's going to lead to the hard landing. Meaning, like, if the soft landing is there, then you're
it's like a reverse psychology situation.
right. So, like, is it when I throw the towel in on the soft landing, or when I finally believe in the soft landing? Is that when the hard landing comes? Right, that's the type of thing that you have to deal with. And the answer is this: very likely there will be a recessionary effect from all of this nonsense. Very likely. The problem is timing that. And that's why you need to use models and you need to use data, because you can't just feel it. It doesn't work like that. Obviously, there's a lot of people that are using their feelings, and they're crying every day the S&P 500 goes up because their puts are getting destroyed. Okay? And that's the problem. You can't use your feelings. You have to look at the whole picture. And the big picture here is this: the soft landing will continue. And very likely, I would almost guarantee this gets coined as a soft landing, just like how it's laid out in the compound landing. Everyone believes this is the soft landing is coming. The market's going to normalize, going to price in, yield curve maybe even gets a nice reversion out of it. Everyone's like, okay.
Which you can make money off this too, right? You don't have to
course.
wait for a recession. This stage 3 soft landing could go on for a while, and it has been going on for a while already. And the NASDAQ could go much higher before we hit stage 4. There's definitely money to be made here.
Right. And, like, it would be easy for me to tell you, like, oh yeah, we're 6 months out. We're 3 months out. That's not how it works, because we just raised 5 percentage points of, excuse me, I'll keep it simple. We raised 525 basis points in a year and a half, right? And literally one of the fastest rate hiking cycles in terms of rate of change basis ever. Okay, there's shocks to this. The bears, to a degree, the perma bears that are screaming like something's wrong. Yeah, okay, there's a shock to it. We understand. The problem is the market doesn't work like that. Those effects are long and variable. How they hit the market, the data will start to tell you when it's culminated enough within the economy to have a significant impact on the outputs of the economy. And until those effects have culminated to a point, everyone's going to look at the surface and say, you know what? There's nothing going on here. Clear skies, flat seas, sail away. Meanwhile, there's a volcano underwater that's erupting. Like, no one can see it, so no one believes it. And that's what stage 3 of this compound landing is about. It's about saying, you know what? There's no soft landing. And that's what I'm saying. I do think the soft landing is going to get coined. Everyone's going to agree. There's going to be a mutual agreement that we're in a soft landing. Obviously, there's going to be those people that are like, you know what? At some point, you're going to have a bunch of people that will, no matter what, be bearish, even in
Yeah,
the
but those
best
are the
economy in the
permas.
world.
They don't matter.
Those, they don't matter. They don't matter. What I'm saying is there will be a general consensus. The soft landing has been achieved. No biggie. No biggie. No recession. No stress. We're coasting into the sunset. And I think that there's a delay between that and stage four. They're all connected. Stage one, two, three, and four are unique to this specific cycle. That's not a normal recessionary cycle. That's something very specific to this extremely lagged and hyper hiking environment. That's just something that the framework that we've come up with to describe what's going on in this environment, particularly. And stage three, we breached the halfway mark of stage three already. The soft landing's been rip roaring, and now it's all about burning out that soft landing pricing. How long can that go? And like I said, we Joe Biden getting on TV saying that the soft landing has fully come, no recession. The cockier people become about there being no recession, and the fact that the soft landing has been achieved is that throwing in the towel moment. And I think that this, even if we get we get the stage four effects, the recessionary effects after this, it will be thrown out of the mix here, and it won't be associated with what's happened here. They'll associate it with something else. They will say the soft landing was achieved, and then this, and this happened, and then therefore the market fell, and because of this, then we went into a recession down the road. And that's all bullshit. It's all connected, right? So like, just because you don't get the recession right now and the soft landing stable materializes, it doesn't mean that the effects of what just happened don't bleed into the recession, unless we're talking like 10 years out, right? Like if we get stage four a year and a half from now, it's connected. 2 years from now, it's connected. 5 years from now, you can argue it's not connected. But that's the whole point. Stage three can last a while. We can go through a whole presidential election. Then if the current individual running, if Trump, right, if he gets elected, obviously you're going to have this euphoric idea behind tax cuts and all these types of pro stock market agenda, which is good for the economy. Lo and behold, right, at the end of the day, it's good for the economy. And that may, again,
I
could it
could
add some
delay the
inflationary?
effects even
Yeah,
further.
yes. Could it add some inflationary problems? Maybe. And Trump is not a fan of Powell. Trump is certainly not a fan of Powell. Trump wants ZERP, low interest rates. That's what he wants. So I don't know if, not necessarily ZERP, but he wants low interest rates. He was throwing a fit when Powell was hiking above, like I think it was like 300 basis points or 250 basis points back in 2018. So like, just imagine the situation right now with inflation at roughly trending down towards 2%. So I think that's where we'll leave it this week, guys. If you guys have any questions, you can reach out to us in our Discord at the Market Radar, in our Discord, which the link can be found on our website at market-radar.com, or you can reach out to us on Twitter at the Market Radar. Thank you so much, guys. Have a great week. We'll talk to you soon.